Which asset will win in 2026?
Equity, debt, gold.
Not sure. But if you've been investing for even a few years, you already know this one truth. The winner keeps changing every few years without any warning. Some years it's equity, then gold, and then debt. That's why this board behind me looks chaotic. Because markets are chaotic and our portfolios feel that chaos. But here's the good news. ETFs were built for this exact world. They let you invest in the market without juggling 20 ideas, without checking charts every morning, and without guessing, what should I buy next? Think of an ETF like buying the whole basket instead of trying to guess which fruit will taste best. And after going through all this research behind me, I've narrowed it down to 3 ETFs that can help you build a portfolio that's growth-focused, diversified, resilient, and most importantly, easy to stick with through market swings. But before we start, one quick thing. This isn't a pick your favorite ETF video. These 3 ETFs play different roles in a portfolio. Also, these are not recommendations, just clear data-backed research from the Angel One research team, so you can decide what fits your goals. Alright, let's start with ETF number 1. If there's one segment that has consistently produced India's next generation of market leaders, it's the Midcap 150. Think of companies like Max Healthcare, Persistent System, and Jindal Steel. All of them spent years compounding quietly in the mid-cap zone before becoming the giants we know today. Motilal Oswal's wealth creation study shows this pattern clearly. And here's why the Midcap 150 is so powerful. It gives you access to 8 industries that don't even exist in the large cap index. So you're not just buying today's winners, you're buying India's next decade. Now let's talk performance. Over long periods, the Nifty Midcap 150 has outperformed broader markets comfortably. Multiple cycles, same result. Yes, drawdowns are deeper and recoveries take time, but that's exactly where SIPs work beautifully. When markets fall, you automatically collect more units, and across a full market cycle, that's exactly how midcaps deliver powerful long-term growth. So why Mirai's ETF specifically? 3 reasons. Low expense ratio, one of the lowest tracking errors in the category, and strong liquidity, meaning entry and exit are smooth, even for larger SIPs. But let me be honest, midcaps aren't for everyone. This ETF is for investors who truly think long-term, 5 years, 7 years, 10 years. Not the ones who panic because midcaps were volatile last year or the year before. Now let us move on to ETF number 2. The second ETF in this portfolio takes us outside India. Not for excitement, but for genuine global diversification. And the cleanest, simplest way to get that is through the Nasdaq 100 ETF. Because this one ETF gives you exposure to 100 of the largest non-financial innovators in the world. Tech, cloud, semiconductors, biotech, digital commerce, without the heavy FANG concentration risk and without the structural uncertainties you see in markets like China. In short, it captures the engine that powers global innovation. Think Apple, Microsoft, Amazon, Facebook, Alphabet, Pepsi, Adobe, the companies shaping how the world works, earns, shops and spends. Now look at this. Since 2011, the Nasdaq 100 has grown roughly 4 times. But the Indian ETF, it grew almost 6 times. Why? Because as the rupee weakens over long periods, your Nasdaq ETF naturally benefits. You get global growth plus a built-in currency hedge. Now let's talk about diversification. The Nasdaq 100 has only about 0.16 to 0.22 correlation with major Indian indices. Meaning, when India zigzags, Nasdaq doesn't necessarily move the same way. That's real diversification. And you know what's even more interesting? Even simple mixes like adding 10 to 30% Nasdaq to an India-only portfolio have historically improved long-term portfolio performance. It's like combining India's structural growth engine with global innovation and a natural dollar hedge, all inside one ETF. So which one do we use? Motilal Oswal Nasdaq 100 ETF because it has the longest track record, strong liquidity and a clean structure. Yes, the expense ratio is a bit higher than passive domestic ETFs, but over long periods, the compounding has been good. And again, this isn't about chasing tech hype. It's about making sure your portfolio doesn't depend on one geography, one economy, one currency. Alright, Now let's add the stabilizer, the ETF that holds your portfolio together through chaos. ETF number 3, liquid ETF. And this one isn't about returns, it's about strategy. Most of us keep money lying in savings account for emergencies, upcoming payments, or waiting for the right time to invest. But here's the problem. Savings accounts give 2.5 to 2.75% and inflation is 5 to 6%. So even if the balance on your screen stays the same, your money loses real value every single year. That's exactly where a liquid ETF steps in. It invests in very short-term, high-quality instruments, T-bills, commercial papers, CDs, which means low risk, high liquidity, and potentially better short-term returns than a savings account. In simple words, it works like a savings account, but with the potential for better short-term returns. And more importantly, it plays a crucial role in your portfolio. When markets look overheated, park money here. When markets correct, redeploy from here. It's your stabilizer, your parking zone. Also, there's no exit load after 7 days, and when you are evaluating liquid ETFs, the two things that matter most are the liquidity and cost. That's it. So it can be a pretty straightforward decision here. So that's the framework. Not one, not two, but 3 different roles your portfolio may need. A growth engine, a global diversifier, and a stabilizer. Tell me in the comments which ETF has been the best performer in your portfolio so far. And if you want us to cover the detailed breakdown of how to choose an ETF, then let us know in the comments. Also, if you found this video useful, don't forget to like, share, and subscribe. It helps us reach more investors like you. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.